Let's say you bought shares in wealthyidiots.com, this great financial coaching organization that's just now getting its start, and let's say it went public for the sake of argument. And it increased in value because this year those guys have been knocking it out of the park. Hey everybody, my name's AJ and this is the Wealthy Idiot Show. Before we go any further, please make sure to destroy the like button for the YouTube algorithm, subscribe to the channel, comment down below. Whatever you can do helps us spread as much good financial information as we possibly can, and we can help people avoid those bad financial mistakes and get rich quick scams trying to separate you from your money. So unless you've been avoiding the news like the plague, you probably have noticed that our economy isn't doing so well. The NASDAQ hit a 2-year low on Monday, inflation is at a 40% high, and companies are already starting to lay off employees in expectation of a continuing and maybe a worsening recession. That's not great news for most of us. And to top that all off, the IRS has hired more agents to go after people's money, and they're getting ready for this next year of collecting tax income on top of this already struggling economy. If you've been a part of the world at all, you might have noticed this giant organization filled with people wearing suits whose entire goal is to separate you from your money and hand that money over to rich people. Did I say that out loud? However you feel about our government, one thing seems to remain true for most people. We want to avoid paying taxes as much as we possibly can. We don't want to illegally avoid paying them, but we want to find ways to legally avoid paying taxes, especially if it doesn't cause us any actual loss of money ourselves. So if you're tuning into this channel for the first time, I'd like to talk about real estate quite a bit. One of the main advantages of real estate is that we can buy an asset which is growing in value, and in the meantime, while we hold that asset for quite a bit of time, like 27 years or so. One of the commenters corrected me recently. We can depreciate that asset on our tax form. We can write off interest on loans. We can write off repairs on the property. And as long as those look like they're bigger than the income we're making on the property, it looks like on paper we're taking a loss. But we have this great asset and we're also receiving cash from our residents who are staying there. This ability to show a loss when you're actually producing a gain is one of the best tricks to avoiding taxes that currently exist out there. And it turns out there's a way to kind of show losses in the stock market as well, so that you can avoid paying taxes without losing any more money than whatever your asset has already dropped. And right now, because the economy is struggling so severely, this is the time that this probably applies to most of us. I know it applies to me and my partner, and it's something that we're going to use to try and avoid paying taxes in 2022, or for 2022 in 2023. This method is called tax loss harvesting. You wouldn't believe the amount of times I had to try and say that to get a recording that actually worked. That was a tongue twister. And this is used to offset capital gains by claiming losses. We've told you on this channel before not to take money out of the market, even when the market is struggling. The reason for this is that we want to continue to see our assets grow over time, and we want to be able to lower our dollar cost average through this bad economy, but we want to continue putting more money in, and then we want to see it grow on the other end when the economy bounces back. However, there's a way to keep your money in the market, quote unquote, while claiming losses. So right now, most of our stuff is probably down. I have several index funds and other trades that I've made that have just gone down, have received losses, but I haven't sold them, so I technically haven't received those losses yet. Well, on paper, we can make those look like losses by selling those assets. So if our purchase price was up here and we're selling down here, then it makes it look like we've lost money. Realistically, we're not moving our net worth needle at all. We can take that money and invest it into something else as long as it's different enough. You may have to do some research on that, but in terms of like, if you have stock in the tech market and you pull it out and you put it in the energy market, that's actually considered different enough. So if we take our assets out of a particular index fund, we can take it and put it in another qualifying index fund. We technically don't lose any net worth because we just moved our money from one asset to another. But because we bought the asset up here, it looks like a loss on paper. Now, if we go sell something else, could be real estate, could be other index funds or mutual funds that have a gain on them, we can offset those two to make it look like we didn't make any money, and we can take that cash tax-free. That's called tax loss harvesting. You can even use tax loss harvesting against $3,000 worth of your W-2 income. So let's say we didn't make any capital gains. We could just go ahead and sell some assets that had some losses, turn around and buy other assets that aren't similar, but are also assets that we like other index funds and other industries, and we can write off against $3,000 of our actual W-2 income to lower our tax burden. So let's go through an example so I can show you what I'm referring to. Let's say you bought shares in wealthyidiots.com, this great financial coaching organization that's just now getting its start, and let's say it went public for the sake of argument. And it increased in value because this year those guys have been knocking it out of the park. And you're going to sell some of those shares so that you can realize the gains and maybe use the gains on something else. Real estate, partying, vacationing, whatever it is that you want to do. So you realize $20,000 worth of gains. Well, those may be short-term gains or long-term gains, but either way, you're going to pay somewhere between like 15 and 30-ish% depending on whatever the current rate is and whether or not the government has adjusted it. That seems to be the location in which they adjust the rate, is between 15 and 30%. And you don't really want to pay that 30%. If you realize $20,000 in gains, 30% is going to be $6,000. 15% is $3,000. So however you cut that, that's a lot of money that you're going to have to hold on to when it comes around to tax time so that you can cut a check to the IRS for that amount. But let's say you also invested into something else. We're not going to name the company, but let's say competitor to wealthyidiots.com, whatever that may be. And you lost $20,000 in that competing company. You still own the asset, it's just that it devalued about $20,000. So when we sell it you bought it at this amount and you're selling it at this amount, and this is a $20,000 loss. So on paper, it's going to look like you made 20 grand selling Wealthy Idiots and you lost 20 grand selling the Wealthy Idiot competitors. And when we put the two and two together on your IRS form, it looks like zero. You take the money that you got from the competitor's sale and you turn around and put it in something different enough. So in this case, let's say we're going to just put it into energy index funds. That's different enough. Or international index funds, dividend paying index funds. Any of those things are different enough from the two that you originally purchased. You didn't actually realize a loss. You just moved the loss over to a new product, and we'll put it into something that we expect to grow on the other side of this recession when the bull market comes back. So we'll still see those gains, and we'll be able to take our $20,000 totally tax-free and maybe spend a little bit extra on tacos during our vacation. That sounds like a good time to me. Some things to watch out for. You can't do this when it comes to retirement accounts like 401ks and IRAs. Those whole accounts, as long as we leave the money in that account, even if you trade in that account, doesn't really see gains or losses. You have to actually remove the money from that account to receive the gain or losses, so this doesn't apply. This would only apply to things you have in the market, things that you have with your ordinary brokerage firm, or cryptocurrency, which is pretty cool. And the other thing to watch out for, and I've explained this just during this episode, is something called the wash sale rule. And that prevents you from selling something at a loss and turning around and buying the exact same thing. So the rule says you have to buy something different enough. And so you could sell an index fund and buy another index fund as long as the things inside of that index fund are significantly different from each other. So an index fund selling that focuses on tech for one that focuses on energy is totally fine, even if the index fund is in the same company. You can find more about the wash sale rule to make sure that you're following those rules as you're doing this process. And I would strongly encourage you to do so to make sure that you're following the rules correctly and you don't get in trouble at tax time and end up having to pay more taxes than you ultimately expected. If you're an investor generally, this might affect you, especially right now. I know things are low and everything looks a little bit bleak, but we could take any opportunity we can to try and save money to help our investments and protect them from the IRS trying to take as much as they possibly can. This is another good trick that the wealthy use in order to protect their money. It's also a trick that fund managers use to try and protect against taxes as well. So I hope you learned something today. Tax loss harvesting might be a great way for you to realize some gains and negate them with some pretend losses on paper, just like we do with real estate. And then hopefully this video will help you use your gains so that you can enjoy life Or maybe plan on investing those gains in somewhere else that you think might actually do better. If you're looking for more financial information to help you out, I would suggest heading to wealthyidiots.com. That's where I learned about tax loss harvesting from the articles on the wealthyidiots.com. Please make sure to like and subscribe. We super appreciate you guys, and we'll see you guys next time.